What leverage really is? Who doesn't know the answer? It's when you are using a long stick to lift things. A lever basically lets you move something very heavy using little effort. But what if we are talking about finances? Should be something much more complicated, right? Don't worry, if you know what leverage is in physics, understanding it in the stock market won't be a problem. Financial leverage is based on the same concept: use a little of your power to get bigger results. You invest a small amount of your own funds and receive an unproportionally big profit. But what would be the lever in this case? It's the money you borrow, or in other words, a debt. A good example of such leverage that almost everyone is using is a mortgage. When you decide to buy a house, you've usually got about only 10 or 20% of the sum needed. You can buy yourself a camper with this money, but let's assume you are aiming at something bigger. To get a better deal, you borrow money from a bank, and that would be your lever. If your property rises in value over time, you will be the only one to profit from this. Individuals are not the only ones to use leverages. Businesses are investing their debts all the time. Have you ever heard of highly leveraged companies? That means they have more debt than equity. This may sound like a bad thing, but it's not necessarily so. Banks all over the world are among the most leveraged institutions, and they are doing well. Why? Because they use the borrowed money for investing and get good returns. Leverage in trading is more or less the same. You can invest a bigger sum where just a fraction is your own money and all the rest is borrowed. This scheme allows you to collect higher returns that wouldn't be possible if you were using only your own funds. Do you want an example? Imagine you want to buy stocks of a company that you expect to perform well. You have, let's say, $5,000 to invest. If the stock price rises by 10%, you'll get $500 as a profit. However, if you borrow an extra $5,000 and invest $10,000, your profit will then be $1,000. Quite an impressive difference, isn't it? So how do I get those leverages? Leverage in personal investing usually means buying on margin. That means you buy assets with the money you get from your broker. To do this, you'll need to open a margin account, which is a bit different from a regular one. This account lets you spend not only your own money, but also brokers' money to buy securities. On this account, you deposit your $5,000 and get another $5,000 from your broker. Now you can spend this bigger sum at your own discretion. However, keep in mind that the equity on your account will be considered by your broker as the collateral for your debt. Another option for using leverage is future and option contracts. They are leveraged products by default, as at the beginning you have to pay only a small fraction of the contract. By buying futures, one locks the price of an asset for a couple of months. With options, gets the right to buy an asset for a specified price in a specified time. When those contracts are used for speculation, not to actually buy the asset before expiring, you'll never have to pay the whole contract price. Unfortunately, options and futures are not easily accessible for individual investors, although some brokers are trying to change this situation. Considering this, leverage exchange trading funds could be a more convenient choice of getting profit from borrowed money. They are not just following a certain index as other ETFs do. They are designed to magnify gains and losses of this index with the help of debt and financial products. In this case, you don't need to have a margin account or give your assets as collateral. All you have to do is to buy leveraged ETF stocks, and the fund will deal with all the borrowing and investing in derivatives. By the way, brokers are not the only source of getting more money for investments. You can as well take a loan from a bank and invest this money the usual way. Are there any downsides to using leverage for investing? You bet. A lever can give you extra power, but if something goes wrong, it may as well hit you in the face. Leverage is a risky play. It allows you to amplify your profits, but at the same time it might amplify your losses too. Whenever leverage is used, there is a possibility of bigger failure than in the case of using only your own money. How so? Let's go back to our margin account where we have $5,000 of our funds and another $5,000 we've borrowed from the broker. If we invested all $10,000 in stocks that dropped by 10%, we would lose $500 more than without leverage. The same principle applies to all leveraged products. If something goes down, the leverage makes the fall deeper. That's why using leveraged products is not recommended for non-experienced investors. One should gain some expertise in the stock market before trying to get profit from debts. That's all for today's video. I hope you find it interesting and helpful. Let me know what you think about the use of leveraged products in the comments below. Thanks for watching, and don't forget to subscribe so you don't miss any of our new videos.